Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to Money Talk at the start of a brand new month and a new working week. It's Monday the 2nd of September. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, China's factory activity contracted for a fourth straight month in August, the latest sign the world's second largest economy may struggle to meet this year's 5% economic growth target. The official Manufacturing Purchasing Managers Index declined to 49.1 from 49.4 in July. The gauge has been below the 50 mark, separating growth from contraction for all but 3 months since April 2023. And August's decline was the steepest since February. The composite PMI was at 50.1 in August. That's the lowest figure since December 2022. China is considering allowing homeowners to refinance as much as $5.4 trillion of mortgages to lower borrowing costs for millions of families and boost consumption. That's according to a Bloomberg News report on Friday. Under the plan, homeowners will be able to renegotiate terms with their current lenders before January, when banks typically reprice mortgages. They would also be allowed to refinance with a different bank for the first time since the global financial crisis. The Federal Reserve's preferred measure of underlying US inflation rose at a mild pace, and household spending picked up in July. The Personal Consumption Expenditures Price Index held steady at 2.5% in the year to July, compared with economists' expectations of a 2.6% rise. Personal income rose 0.33%, while consumer spending rose 0.5%, up from 0.3% previously. Spending continued at a solid clip, even though the personal savings rate fell to 2.9%, the lowest since June 2022. Nippon Steel and other Japanese steelmakers are urging Tokyo to consider curbing cheap steel imports from China, the world's biggest steel producer, to protect the Japanese markets. Nippon Steel Vice Chairman Takahiro Mori said in an interview, China's steel exports surged this year to their highest since 2016 as domestic demand slumped due to the protracted property downturn. A lot of other countries, including in Europe, the US and South Korea, have introduced defensive measures, which means that exports will pour into Japan if it's the only one without them, Mr. Mori said. With us this morning are Alex Wong, Director at Alex Kaiyuan Wong Asset Management, and Mark To, Managing Director of Asset Management at the Fung Financial Group. Later on, providing a view from mainland China, will be Brock Silvers, CIO at Kaiyuan Capital. They'll be discussing the latest business and finance stories with me, and you can get more details on those topics in my Asian daily newsletter, which is at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks closed higher on Friday as encouraging inflation data boosted investors' hopes that the Federal Reserve might cut rates next month and that the world's biggest economy may achieve a soft landing. The S&P 500 advanced 1%, closing at 5,648, recovering from losses of 0.2% earlier in the session. The Dow jumped 228 points, or 0.6%, to close at a new all-time high of 41,563. The Nasdaq Composite gained 1.1% to end at 17,714. All but one of the Magnificent Seven advanced Friday. The S&P 500 notched its fourth straight winning month, posting a 2.3% gain in August. The Dow climbed 1.8% in August. The Nasdaq Composite clinched a 0.6% advance for the same period. Shares of Nvidia, which retreated 6.4% Thursday following its earnings report, rebounded 1.5% Friday. That leaves the stock down 7.7% over the week, but up almost 17% for the month. Nvidia shares have gained 141% this year alone, pushing its valuation above $3 trillion at one stage and making it the second largest listed company in the world, behind Apple. The yield on the 2-year Treasury note was up 2 basis points Friday at 3.92%. The yield on the benchmark 10-year note was up 4 basis points at 3.91%. Yields were down sharply over the month, led by the short end. 2-year yields fell 34 basis points in August, while the 10-year was down 12 basis points. The US dollar index saw its biggest monthly decline this year, falling 2.2%. The greenback's weakness, however, has proven beneficial for the likes of China's yuan, which has erased the declines for 2024. The onshore yuan rose 0.1% to 7.09 renminbi per dollar on Friday. That's a 14-month high. The Japanese yen traded around 144.16 per dollar on Friday, a decline of 0.8% on the day. The yen was up for the second consecutive month, climbing 2.5% in August. Gold rallied to new record highs in August. Spot gold eased to $2,503 per ounce on Friday, but notched a second consecutive monthly advance, adding 2.3%, and its fifth positive month in the past 6. Brent crude oil futures settled 1.4% lower at $78.80 per barrel on Friday, notching a second consecutive monthly decline, down 2.5% in August. Bitcoin was lower by 0.4% Friday at 59,140, and it saw a 9% monthly decline. Mainland China's CSI 300 index climbed 1.3% to 3,321 Friday. For the month of August, the index was down 3.5%, hitting an almost 7-month low last week. And Hong Kong led stock market gains in the region on Friday. The Hang Seng index jumped 203 points, that's 1.1%, to 17,989. For the month, the Hang Seng rose 3.7%, the first rise in 3 months. And the Hang Seng projected to open about 130 points lower this morning at around 17,860. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. At the beginning of September, we have with us Alex Wong, Director at Alex Wong Asset Management. Morning, Alex.
Hi, morning, Peter.
And also with us is Mark Toe, who is Managing Director of Asset Management at the Fung Financial Group. Good morning to you, Mark.
Good morning.
China's factory activity contracted for a fourth straight month in August, the latest sign that the world's second largest economy may struggle to meet this year's 5% economic growth target. The official manufacturing PMI declined to 49.1 from 49.4 in July, the National Bureau of Statistics said on Saturday. Economists had been expecting a higher reading of 49.5. The gauge has been below the 50 mark, separating growth from contraction for all but 3 months since April 2023. And August's decline was the steepest since February. The non-manufacturing measure of activity in construction and services rose to 50.3, boosted by consumption during the summer holiday season, the NBS said. And that compares with a forecast of 50.1 and a July reading of 50.2. The composite PMI, which combines both manufacturing and services, was at 50.1 in August, edging down from July's 50.2, and that is the lowest level since December 2022. Alex, why are manufacturers so gloomy?
Well, I think they're probably expecting more tariff elsewhere in the world. And I think domestic demand remain weak. And also they are seeing lower profits of those retailers. So they could expect lower orders and probably they are still dumping inventories. So I think domestic demand is weak and exports are not looking good. Probably we may still have some support from the expectation that we may have some tariff coming, so there will be a rush in order later on. But I think they would expect the outlooks to be gloomy because exports probably may not be strong next year, and then the domestic will remain weak. And also we have some weather issue, hot weather. And also some rainfalls, heavy rainfalls also affecting the sentiment, I think.
So what is it going to take to turn this around? A lot of people waiting for stimulus from Beijing, and also a change in the way the government supports the economy. Instead of pouring funds into infrastructure projects, maybe targeting stimulus at households. What do people want to see?
I think they probably would like to see stimulus towards consumption. And the latest measure to allow people to reshuffle their mortgage actually is already one step. But I think it is quite difficult because China economy is too big. We are talking about the refinance of a 5.4 trillion mortgage, and the result probably hundreds of millions benefit to consumers. But I think they will still reckon because we have 1.3 billion people. So if it spread out, the benefit actually is not that much. So I think it is quite difficult to turn it around. We need to build up confidence among those consumers, especially young people. So I think this is a long way to go.
Okay, I'm going to once get on and talk a little bit more about this mortgage refinancing scheme in a moment. But first, Mark, let me bring you in. What does this data tell us about the state of the economy and whether or not the economy can meet its 5% growth target this year?
I concur with what Alex said, and actually it is quite difficult at this moment because even though people might or might not be expecting from the government some kind of measures, but these measures are most probably monetary or fiscal. They are just targeting the cyclical problems instead of structural problems, which is now more fundamental to the situation or the status that you mentioned. So right now, I think the confidence, how we can rebuild the confidence, it all depends on the number one, the clashes between the United States and China, and also number two, how the current leadership is going to respond to the potential reactions of these clashes. Basically, we can see that for the past 10 years or so, actually it is some kind of preemptive actions, just in case the United States is going to take some measures. We are going to respond some kind of preemptive actions to protect China itself from the global hostility towards that kind of thing. So I think it is a little bit difficult at this moment. Whether it is reflected in the property prices, in the consumer confidence, in the manufacturing, in the PMI, every kind of measures are pointing to something like that. So basically, I think all the people, whether it is from the higher rank officials or just normal citizens, they all understand the situation very well. They don't expect too much, so that they won't have too much of disappointment.
But both of you have mentioned really the effects of tariffs and sanctions. So do you think, Mark, that these are having a big impact on the economy now?
Yes, of course, and actually it is not something that is to be felt afterwards. Rather, people expect it from the rational expectations point of view. We can expect that the future administration, whether it is Biden or Harris, they are basically still doing pretty much the same towards China or the Harris or the Trump. Basically, I think all these are just the same. And it hasn't started in recent years, and actually it goes back. It can be traced back to at least 10 years or 15 years ago. So I think the situation is not going to be improved one night, and it is going to stay for a longer period of time, and people would better have preparations for the worst.
Okay. Alex, you mentioned this mortgage refinancing scheme, which was reported by Bloomberg News. Basically, China's going to allow, or is considering allowing, homeowners to refinance as much as $5.4 trillion of mortgages to lower their borrowing costs. Under the plan, homeowners will be able to renegotiate terms with their current lenders before January, when banks typically reprice mortgages. And also, they're going to be allowed to refinance with a different bank for the first time since the global financial crisis. Now, Alex, the measures that we've seen before, like lowering the loan prime rate and so on, have really helped new buyers, but they haven't helped very much existing homeowners. So is this going to make a significant difference now, and could it help revive consumer sentiment?
It is not helping too much, I think. As I've said, the China economy is too big. And if you spread out the advantages, benefits to those homeowners, actually, that would not mean much. So probably they would increase their savings. So and they probably would park in some bonds or insurance only. So I think that is of course helping a little bit, but that is hurting the banks, and I think this would hurt the investor confidence towards banking shares. So I think overall this is a beneficial move, but because the magnitude of the whole economy is too big, and I think people actually may not spend that money anyway. So I think that would not have too much impact.
And the banking, you mentioned the banking sector, the banking industry's average net interest margin is at a record low at the moment. As of the end of June, it was 1.54%, well below the level that really banks need to maintain profitability. You're saying this is going to hurt the banks even more?
Yeah, I think that it hurt banks even more, of course, because the risk is the same, and then you get a lower reward because of this new measure. So that means you have a lower net interest margin coming. And also the whole interest environment in China actually is going down. So that means the net interest margin actually is going to go down.
The markets, though, seemed to like this measure, didn't they? In Hong Kong, the Chinese developers jumped quite a lot on Friday. Shinmeo was up as much as 28% at one stage. China Vanke jumped 17%. Why were they so positive?
Oh, I think that is a relief rebound. And the market actually selling those banking shares on the last two trading days last week. So this measure hurt one sector, but it is helping the sentiment towards the consumer sector, the property sector, and probably insurance sector as well. So I think this policies is welcomed by the market, but is hurting one particular sector at the moment. But I think if they examine the long-term impact, probably the Chinese property market will still be bad, and so the property shares will not have a sustainable recovery from here.
Mark, what are your thoughts on this? Do you think this will boost confidence among homeowners, particularly in the secondary market?
Yes and no. Actually, for the very short term, I think from time to time there might be some kind of rebounds, just like in April or right now. There are some policy relaxations here and there. I think that might help a little bit, at least for the investors' confidence to a very short extent. But in the long run, I still think that just like what Alex said, it is not going to be solved in a very short time. And I think the problem is that the property prices actually is a reflection of the expectations of people in the coming few decades, whether they have the income increase, whether they can have that kind of a wealth increase in the long run. That kind of reflection. But right now, we all know that, and the people in mainland China also know that it is not going to be easy. At least it is something like the pendulum swing back to maybe 10 or even 20 years before, or even earlier. So the whole situation is not going to be some kind of a fast growth for a particular sector. No, it is not something like that. So we have to accept the reality, no matter how harsh it is.
And what does it mean for the banks?
Of course, we know that if it is the government that wants to help in whatever sense the different sectors, whether it is the property sector or the other sectors, most probably the banking sector is acting as the tool, the policy tool, that kind of vehicle to carry out the policy, the messages, all kinds of things. So it is there's little wonder in the past decade or so that why there's such a low PB, why there's some kind of metrics that we may find too good to be true, and because people have that kind of expectations built in. And we all know that the banks are actually the policy tools to a certain extent.
Let's switch our attention to the US because we had some data out on Friday. The Federal Reserve's preferred measure of underlying US inflation rose at a mild pace. Household spending picked up in July. The Personal Consumption Expenditures Price Index, which is the Fed's preferred measure of inflation, held steady at 2.5% in the year to July, below expectations of a 2.6% rise. And the core PCE, which strips out volatile food and energy, rose 2.6% year on year, matching the prior pace, but beneath economists' forecasts. And those figures come after Fed Chairman Jerome Powell at Jackson Hole said the time has come to begin cutting rates. There was also some other data. The University of Michigan Consumer Sentiment Index was revised higher. And also GDP, second quarter GDP growth was higher than initially reported. US GDP grew by an annual 3% in the 3 months to the end of June. That was up from an initial estimate of 2.8% and around 0.2 percentage points higher than analysts had expected. Alex, put all this data together, it rather supports the idea of a soft landing for the US economy, doesn't it? No sign anywhere there of a recession.
Yeah, right. I think people just put the emphasis too much on the job data. So and two or three pieces of weakness suggest it suggests that there will be a risk. But I think that people put too much emphasis on that. But anyway, I think a market like that because we have a soft landing scenario and also the inflation is under control. So we have a rate cut coming. And that would help the market further, I think. So they like it. The performance is not too bad, and also we have inflation under control, so everything looks fine at the moment right now.
It doesn't really justify, though, in September a 50 basis point rate increase, does it? It makes it look like more. It's going to be around 25.
Yeah, right. I think the pace of rate cut actually should not be too fast. The risk of inflation remain, and then the economy is not too bad. So I think they would take it very prudently. So I think we probably will see just a quarter point, unless we see a very sharp downturn in the job market at the latest payroll figure.
Mark, what are your thoughts here on all this data? Putting it all together, it looks like the US economy is doing quite all right, isn't it?
Yeah, some people even say that the so-called U.S. exceptionalism is still here at work. I think the inflation itself is gradually tamed, so much so that the policy objectives are going to be balanced. And basically, what Jay Powell said in Jackson Hole is that. We're going to be more careful about those factors that we haven't been putting on the emphasis too much in the past. And right now, it's the jobs, the full employment, something like that. I tend to think that a 25 basis point is most likely, and actually for the coming few FOMC's meetings are going to be gradually moving toward that kind of gradual baby steps so that they can manage the expectations more easily. And they can still be data dependent rather than data point dependent, which they have been criticizing what the market participants have been. I think they are going to start cutting rates in September. But whether they will keep on that pace is really hard to say. They don't have to respond to every single data, just like ECB or the other central banks in the world. They are basically saying the same thing. They're taking the data gradually into account, but they don't have to overreact or underreact.
But presumably the markets, they're expecting 100 basis points of rate cuts this year. That seems hard to achieve, doesn't it, under the current scenario?
The market, no matter how you measure it, has been expecting a lot of things since last year. And I, for one, have been expecting 2 rate cuts at most by the end of 2024. I have been making that kind of predictions since last year, the end of last year. But you could see there have been ups and downs in expectations in the forecasts. And right now, the situation, I think 1 or 2 is still the most likely, the optimal situation for both the central bank and the investors, because they can more easily adjust to the other paces as long as the data didn't deviate too much from the current state. Basically they have that kind of path dependency in their policies, and don't forget that they are just technocrats. They want excuses, they want alibi just in case something goes wrong. And actually, they have been criticized for being too slow in responding to these behind the curve, all kinds of things. But still, their behavioral pattern looks just the same. They want the whole situation to be more likely under control in that sense.
What could go wrong? Is there anything that you could see on the horizon that could derail this Goldilocks scenario for the US economy and send it into recession?
Things can go wrong pretty quickly, just in case the U.S. Presidential race is going to have some surprises for us. Even though right now we can see that Harris basically have level up with the Trump edges in the poll. And I think the geopolitics may be one thing, but most likely it's going to be just the same Goldilocks. I agree with that. That kind of equilibrium is going to stay. So as long as the Fed doesn't react too much too quickly, I think things are going to be all right.
Alex, the impact on the markets here, it was a good month in the end for August, wasn't it? Despite the dodgy start, the S&P 500 very close to an all-time high. The Dow is at an all-time high. We've had the NVIDIA results now. Where do we go from here?
Well, I think we probably may still see fall into those traditional shares from the tech. Right now, the Dow actually is making new high, and other indexes actually lag behind. So I think probably people would still expect those traditional shares to offer value. And for the tech, probably just consolidating. So, and Russell 2000 actually is affected by SMCI. I think a supermicro computer actually scare people away from smaller companies right now. But I think as a group, they still probably would be okay. So that would be more risky, but I think upside in the Russell 2000 actually remains attractive. So I think overall, I would bet on the traditional sectors instead of the tech right now. Tech probably just for tech probably I think just pick 2 or 3 or a few group for companies which probably would still be okay for the long term. But in the meantime, I think forward would be more positive for those traditional sectors.
And would NVIDIA be one of those companies?
If I want to keep tech, I would keep Meta, keep NVIDIA, and Broadcom and TSM. I think these 4 actually should be the best one to pick among the AI firm.
Well, what we did notice in August, in fact started really a bit before that, several months before that, that most asset classes in the US are rising in tandem. Equities, government bonds, credit, all going up together. We've had the longest stretch now of correlated gains since at least 2007. Do you see that continuing?
Oh, I think that probably may still see some decoupling. I think bonds actually are showing some weakness in the long end. So I think people would not be too bullish on the 30-year, but they are okay with the shorter tenure. I think that probably would be the one to derail from the current correlation. And then For others, I think they will still be a little bit correlated. I think in the meantime, people like commodities and also like the equities right now. So I think they would be correlated highly still. So probably we will still see a high correlation to stay.
And what about the US dollar? That had its biggest monthly decline of the year. Is the dollar going to stay weak?
I don't think so. I think we probably see some stabilization. The yen actually, dollar yen rate already found a fall, I think, around 143 something this time. And I don't think the strength in the renminbi is sustainable. And if you look at emerging market currencies like Mexico or South Africa, actually, they are not too strong. So basically, it is a yen strength and also the euro strength right now. But I think for the part of the yen, I think probably it will not strengthen further.
Mark, what are your thoughts about the US markets? First of all, how important is NVIDIA to the US markets going forward?
I think it is important as long as we are looking forward to some kind of leadership. And we all know that however you dream of the AIs, you still have to get that kind of, just like in the gold rush, you have that kind of tools for you. And that's the story at this moment. And I think it is still fundamental to the core. But still, the high variations may scare people away from it from time to time. So I agree with Alex that people may shift more and more to the to maybe the small and mid cap, the brick and mortar economies, because they are going to benefit from the interest rate getting lower and lower from now to 2025 in a foreseeable way.
So you would also switch out of tech into some of the other sectors?
I think the rebalancing actually has been started, and maybe since since April or if not earlier, and you can witness that in Russell 2000 in the other indexes. Basically, people have been doing that, and as long as we are still having some more rate cuts on the way, we are going to see that. But still, you are not dumping all the NVIDIA. You are not dumping all the tech stocks, the tech giants. No, it is not going to be something that we can see in the foreseeable future because people are still looking forward to the growth. That kind of growth, the so-called traditional or the old economies are not going to provide. They can provide some kind of valuation. The benefit from the lower valuation, but from time to time, that kind of valuation may dissipate fairly quickly.
Alex, what about local markets here? The CSI 300 down for the fourth straight month now. It hit an almost 7-month low last week. For the month of August, the index is down 3.5%, although the Hang Seng is doing better. It had a good day on Friday. It rose above the 18,000 level at one point for the first time since the 15th of July. So what are your thoughts on the local markets, Alex?
I think Hong Kong will still outperform A-share. First of all, I think the A-share market is affected by the weakness towards the consumer stocks because people are still expecting the inflation and lower profits for those consumers companies. So I think would still remain bearish. And in Hong Kong, I think the return of buyback of many blue chip equities is helping because ahead of the results, they are not allowed to do that. And then we are seeing the resumption of buyback, and that is supporting. If you look at Tencent, actually, buyback accounted for at least 1/5 of the turnover daily. So I think that is providing a quick support in this fin market. So I think that's why we are outperforming the Asia market. But overall, I think sentiment remains weak here. So we probably will just be ranging. But one sector which is particularly interesting would be those Chinese insurers. I think people have been too bearish earlier, and then the latest results show that people are still buying. The new business growth actually is very encouraging, and I think people have been too bearish because they expect the interest rate environment in China to go down, and then they probably would be suffer from those guaranteed return in those old policies. But I think from as time expires, then probably the impact would be less and less. And if new business growth is okay, then as well as then the profit from those new policies would be helping as well. So I think this sector is particularly interesting right now. Probably offer some speculative value, at least towards one sector.
And the ALEX index, it's almost a year old now. It was constructed last September. It's up 27.8% since then. The Hang Seng index up 1.1% over the same period. The ALEX index has in it HSBC, China Mobile, CNOOC, China Resources Power, Xijing Mining. Are you tempted to add an insurer to that then, like AIA or something?
Oh, no, I don't think so. I think that actually would have a strong one in short term, but I suspect whether that would be sustainable. I expect probably 10 to 20% in short term, but I don't think that is a structural change. So I think this is risky to hold for long term. But for ALEX index, I think those 5 members are quite safe to hold for long term.
Okay, Mark, final thoughts from you on the Chinese market. The CSI 300 hit a 7-month low last week. It's the mainland markets are the only major indices in Asia that are negative for the year. What can turn this around?
It's difficult. We have to repeat it again and again, but somehow the bearish tone have gradually reflected or priced in the market prices. So I think from time to time there may be people who look for that kind of mean reversion, whether it is by the mid of this year or by the quarter ends. I think it is going to happen from time to time. Just that people have to move to have a swift actions taken instead of sitting here for waiting.
Okay, thank you very much. Have a great week. You heard there Mark To, who is Managing Director of Asset Management at the Fung Financial Group, and also Alex Wong, who is Director at Alex KY Wong Asset Management. I'm joined now by Brock Silvers, who is Chief Investment Officer at Kaiyuan Capital. Good morning, Brock.
Good morning. Another interesting Monday.
It is indeed, isn't it? Plenty of data out on Friday to look at. We had China's factory activity data, unfortunately, contracted for a 4th straight month in August. The official manufacturing PMI declined to 49.1 from 49.4 in July. The non-manufacturing measure did do better. It was at 50.3, boosted by consumption during the summer holiday season. But the composite PMI, 50.1, just above that level that separates expansion from contraction, and it's the lowest figure now since December 2022. It seems all rather gloomy, doesn't it, the outlook for the Chinese economy when you look at this data anyway?
It does. Look, the PMI news was not a pretty picture. Month to month, not only did we drop, but it was the lowest in 2 years. More importantly, it also missed target. So, the Reuters median forecast was 49.5, which means economists expected August to be an improvement over July. And I think the data is pretty clearly showing us something else. The outlook, I think, is slightly negative, but it's also declining. Now, exports seem to be showing us they won't lead a recovery. And much of the world is increasingly opposed to kind of being a dumping ground for Chinese overcapacity. So that's another factor. Given the likelihood of a Trump victory in 2 months, which I see, I'm bearish on exports to the U.S. in 2025. So none of that is pretty. Let's be realistic, though. China's economy is not imploding. As you mentioned, non-manufacturing PMI was slightly positive. Retail data is okay, not bad, but still below pre-COVID. So the economy is muddling forward, albeit without really trying to resolve serious overhanging risks. And until we see that kind of more decisive action, I don't think a wait-and-see strategy will be productive. So what does that mean? 5% this year is probably a pipe dream. I can't see that happening. And either China actively takes kind of systemic action in search of stable growth, or we go sideways until the situation forces authorities' hands, and then they'll play a much worse hand at that point.
If it's becoming clear that this 5% growth target isn't going to be achieved, although the Chinese finance minister said on Friday that he thought the economy was still growing at a clip of 5%. He said the performance is genuinely stable and progressing steadily. If that is the view of the Chinese government, presumably there's not much incentive for them to enact any more stimulus and try and sort of boost, in particular, the consumer.
Well, they are the greatest econometric forecasters in the history of forecasting because they're rarely wrong. So, look, they can say that we're going at a 5% clip. I don't buy it. Even if the numbers come in there, I'm extremely skeptical. But I do think the economy is doing well enough so that it does take off the immediacy of the urge to take decisive action. And in my view, things are going to have to get worse before they feel that urge and then can start to get better.
So does this mean that really, given the state of the economy, monetary policy and fiscal policy is too restrictive?
Look, I think they've got a real economic problem on their hands, and they've been kind of dancing around the edges, without really getting to deal with core issues. And I think at some point, probably sooner rather than later, everyone's going to be forced into taking much more decisive action. And that's probably fiscal and monetary.
So do you think this measure that's being reported by Bloomberg News on Friday, that China's considering allowing homeowners to refinance as much as $5.4 trillion of mortgages to try and lower borrowing costs for existing householders and also be allowed to refinance with a different bank, the first time they've allowed that since the global financial crisis, is this a significant step that's going to make a difference?
Well, it sounds like more dancing around the edges. Look, we don't know any of the details around this rumored policy, but still, color me skeptical. A couple of issues. Will it even be implemented? Banks are already facing record low margins and poor earnings. Nothing here is free, and the banks are likely to be highly resistant to taking another hit for the team. Mm-hmm. Lowering rates doesn't create value. It transfers value from banks to borrowers. So like many measures since the real estate implosion, I suspect this one may never be fully implemented. Now, let's move on. Let's even assume full bank cooperation. Lower prices are, of course, helpful to everyone. A reduced mortgage payment would certainly help borrowers who are living in their homes. But 70% of Chinese household wealth is in real estate, and prices are projected to fall 8 or 9% this year. Mm-hmm. And that's after various market support measures. So the government can insist that real estate is for living, but the data shows it's significantly for investing or speculating. Now, a rate cut, as envisioned here, does very, very little for an investor waiting on delivery of an Evergrande home that's already underwater. Mm-hmm. It may impact his decision on walking away from that mortgage, but it's unlikely to turn him into a raging consumer, which is, I think, the goal here. So I'm uncertain this policy would be dramatically effective, even if it were implemented, and I have real concerns about implementation.
And you mentioned the impact on the banks and their net interest margin. Their net interest margin is already at a record low of 1.54%. And that's well below the threshold that most people regard as necessary to maintain profitability at the banks. Presumably, the government is thinking here, we're just going to have to sacrifice that to try and do something about these mortgages. Well,
and you can imagine there's a number of bank CEOs this week who are just asking themselves, you've got to be kidding me. There's going to be some pushback on this idea, which is why right now it's just a rumored idea rather than a detailed plan. In order for something like this to happen, someone has to pay the bill. And the jockeying right now would be who's going to pay that bill and how much can we force them to pay.
Surely the only entity with a big enough balance sheet to be able to pay the bill is the central government.
Eventually, look, you're going to see, I think, a government-led reorganization of the real estate sector. I think it's inevitable. But that's also very, very costly and probably very politically painful. and that's why people are reluctant to commit to that. So I think we will commit to it, but only after things have gotten worse to a point where we have no real choice, and at that point the government's probably playing a worse hand than they have today.
Let me ask you about the outlook for the Chinese consumer, which is also the root of the problem, isn't it, on the economy? And I ask because we had last week the US listed depository receipts of PDD Holdings, which is the parent company of Temu, of course, plunged over 28% in New York. And that was after the PDD co-chief executive emphasized several times that profitability was going to decline. There was intensified competition. Now, this was supposed to be an area, e-commerce, particularly these types of stores like Pinduoduo, like Temu, that offer discounted products. They were supposed to be doing well, weren't they? Chinese consumers weren't buying luxury goods, but they were going to these places. That seems to have come to an end as well. If it has, presumably this is also a big problem for China.
Look, I think it is. And it also highlights part of the problem is that we're just not getting good data and good forecasting at this point. Very little of what we as investors receive is reliable. So you're going to see, I think, an increasing number of disconnects between market belief, confronted by an economic reality in China. The way to resolve that is to, I think, provide better data and better guidance, but that I don't think is a near-term reality. So we're going to see some upsets, and I do think that the consumer is pulling back in China because there's not a lot of near-term optimism, and the Chinese consumer is plugged in enough to see that. So there definitely is a concern on the consumer front, and that brings us back to the fact that, refinancing $5 trillion in mortgages may help at the edges, but it is not going to turn Chinese consumers. It's not going to turn that machine, shift that engine into high gear.
And what about the local markets? The Hang Seng Index did manage a gain in August. It was 3.7% higher, the first rise in 3 months. But on the mainland, it looked pretty dire. Once again, the CSI 300 was negative on the month. It's also the Chinese mainland indices are the only major indices in Asia which are negative for the year so far. The CSI 300 hit a 7-month low last week and down 3.5% in total for August. No sign yet of this turning around, is there?
No, look, there's a bit of optimism in Hong Kong just because we see some U.S. rate cuts on the horizon, and of course Hong Kong is a dollar economy. But in terms of the Chinese mainland, I think markets are just waiting for an excuse to rally. And they may take some, they may take some courage from the coming U.S. rate cuts, but there's also not a lot of cause for near-term optimism. China's going to have to deal with some major problems in real estate and LGFV solvency if it wants to stabilize at a positive growth rate. And I don't think that's going to happen until the situation gets worse. And overall, I think the geopolitical environment looks set to deteriorate by the year's end. All of which is not good news for the CSI 300. So I think that's going to be, at best, a sideways movement through the rest of the year and probably into next year.
Anything on the horizon at all which could tempt foreign investors back into the market, because they've been dumping shares in large amounts, although that is also now a piece of data that China's restricting, so we don't know anymore just how much they are selling, but we presume that they're still out. What could tempt them back?
Look, I think it's a good assumption that that's a pretty high number. But look, the only thing that's really going to turn this around now is if China reports some surprising data that shows a rebound. I don't think that that's very likely. Or if Beijing relents and says, fine, we are really going to tackle some systemic issues or support markets in a significant way. And there seems to be very little appetite for either one of those outcomes. So I don't think that there's anything that's really going to shake up the market, at least through the end of the year.
And you mentioned Hong Kong. It's a dollar market. Obviously, we're waiting to see if the Fed cuts rates in September. Most people think they will. The dollar's weakened quite considerably over the month against most major currencies. Is this going to help the Hang Seng?
Yeah, it should. Look, it will, but let's also not forget that the Hong Kong economy is really driven by the China economy at this point. So there is some cause for optimism in that U.S. rates will go down. That'll have a big effect, particularly on kind of real estate markets. But ultimately, Hong Kong is still going to be driven by China, and as long as China's looking gloomy, that's going to put a cap on the optimism for the Hang Seng.
Brock, thank you very much indeed. That's Brock Silvers, who is Chief Investment Officer at Kaiyuan Capital.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you for listening this morning. Do please take a look at my daily newsletter, which has more information on some of the topics we've discussed today. You'll find that at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, William Marr, Chief Investment Officer at the Grow Investment Group, and in Washington, D.C., our US economics correspondent, writer and broadcaster Barry Wood. See you tomorrow.
Money Talk